We're 2 months into this year and already speculation around house prices going up, going down, interest rates going up, and a lot of uncertainty. In this video, I want to discuss what some of the banks here in Australia are talking about when it comes to forecasting, house prices and how that relates to interest rates later this year. At the end of this video, I'll of course share my views on what I think is going to happen in this market. If you're interested, keep watching. Hey guys, my name's Ravi and welcome back to Personal Finance with Ravi Sharma. If you notice that things have changed around here, well, it's because I moved apartments. Yes, I finally made the move and this is a work in progress. So hopefully I can keep adding to this studio so that I can make this experience a little bit more enjoyable for you guys. But if you are new here, smash that subscribe button because I talk about real estate, cryptocurrency, and financial freedom. Now in this video, we're gonna go through something that came up in the Financial Review around house prices and forecasting through Australian banks. I think it's very interesting to see what they're saying and what they've said before and why we shouldn't really rely completely on what they're forecasting now. Now, if you are interested in ongoing content, obviously over the last couple of days, I've been very MIA on YouTube, but I have been very active on the Patreon community. So if you are interested in joining that, there's a link in the description below. We're building some amazing stuff out there, but also sharing some awesome alpha. House prices to fall by 11% in Sydney and Melbourne in 2023, NAB says. House prices will end the year roughly flat before dropping 11% or more in the biggest markets of Sydney and Melbourne next year, according to fresh forecasts from NAB. NAB's revised forecast contained in its quarterly residential survey comes just 2 days after Reserve Bank Governor Philip Lowe conceded interest rates could start rising later this year, a possibility economists already anticipated. So it's interesting because NAB was also one of those banks that came out in 2020 and said the market was going to collapse. They came out in 2021 and said,
yeah, we might get about 10% growth. Ended up being a lot more than that.
And we can see here in this quick graph what actually happened in 2020, and we clearly didn't see the market collapse by 30%. In 2021, they forecasted about 10 to 15%. We saw a lot more than that. And so now in 2022, they're forecasting mediocre growth. I mean, no one's really getting out of bed for 1.9% growth in Sydney. And if you really look at hot markets, according to this, bringing Brisbane at 4.2% and Hobart at 4.5%, again, are very much below average. When they're forecasting 2023, it looks like a completely different story. They're suggesting 11% declines in Sydney and Melbourne. If you are interested in sort of what my predictions for this year are going to be, then there's a video I've already made on this channel, which I'll link up here and you can check that out straight after this. The markets are pricing in as many as 4 hikes this year, while borrowers are already signing up to fixed rate mortgages at a higher cost. In terms of forecasts, we have brought forward the timing of the correction we expect in house prices to late 2022 as affordability constraints begin to bite and rising mortgage rates place downward pressure on prices. NAB chief economist Alan Oster wrote in the bank's residential market survey released on Friday. This would offset gains seen in early 2022 so that overall prices end the year roughly flat. We see this trend continuing through 2023, ending the year around 10% lower. So what they're suggesting is 2022 in the first half, we may still have some momentum from the previous year and it's going to still grow. However, by the end of the year, it's going to be a complete taper off. People are going to not want to buy property anymore because rates apparently are going to go up by 4 times. And then in 2023, people are going to then realize they can't afford mortgages and they're going to have to sell. They might have to sell at lower than what they purchased over the last couple of years. We expect this pattern to be evident across the capital cities through the larger declines to occur in Sydney and Melbourne, while Brisbane and Adelaide see less significant declines. I wonder why he's saying that. I'm going to share my thoughts. However, we do not see such declines as disorderly, with the labour market remaining strong, wages growth picking up, and rates still relatively low, though steadily increasing. NAB expects house prices in Sydney to end 1.9% higher this year, with Melbourne posting a mere 1.2% gain. Brisbane and Hobart have the best prospects with forecast gains above 4% this year. So I find it interesting that they've said, well, Sydney and Melbourne are going to get affected. And I actually tend to agree that they're going to get affected most. And why? Well, it just comes down to price elasticity. It means that when we have shifts in prices, we've got a lot more emotional buyers up the top purchasing these properties and they're bidding against each other. It's fueled by emotional buyers. We also then need to be careful, and I've said this on the channel numerous times, that we need to be careful that we don't just look at generalized markets and say, well, if the markets in Sydney are going to decline by 11%, that means my property that is situated in a particular suburb is always going to decline by 11% as well, because that's what they said on these articles and that's what the economists are forecasting, so that everything gets affected in that area. We know that's not the case. We have better streets than others, we have better performing assets than others, more in demand, less supply, and then when you look at apartments versus houses, that's a completely different argument altogether. When they make reference to, say, Adelaide and Brisbane, they're going to be great performing markets, but we also need to question, why are those specifically being forecasted as growth, but the interest rates are going to be affected everywhere, right? So why are they saying that those areas are going to grow, but Sydney and Melbourne won't? And that, I think, personally, is because of the price. We have affordability concerns, so that means people might migrate out of Sydney into these areas, and that's what we've been seeing already. If you remember back in 2020, I came out and said, well, my best place to invest right now would be Adelaide, being South Australia, and the regional markets. Obviously, that's performed really well. Hindsight's a beautiful thing, and it's all worked out really well. And if you did capitalize on that, drop a like for this video because that's absolutely free. Now, when it comes to moving forward and what I think is about to play out, I think it's going to be that the emotional buyers will get wrecked. They've gone out and they've purchased properties way above their means. They've gone out and taken interest-only loans on like a 2% or even subpar 2% loans. Now, if we do see rate hikes, we could see that market capitulate first. Now, do I realistically think the market could drop by 10%? Yeah, I could. Nobody really knows, including myself, what's actually going to happen around the corner. But we can use data, we can use things that we've already learned and the experience of investing for over 10 years. We need to bring that all together to understand what is it that works, what is it that doesn't work, and then go ahead and really make educated decisions moving forward. To be honest, if we did have 4 rate hikes, which personally I don't think is going to happen, but if we do have 4 rate hikes in the next 12 months, that is definitely going to shock the market. But what we've seen over time and time again in the Australian property market is when we do have a decline, and it seems to be a sharp decline of more than 10%, we almost see a V-shaped sort of recovery in the following years after that. So could this be an opportunity for people where they're sort of sitting there on the sidelines hoping that prices do drop? Yeah, for sure. But I'm also worried for the market because they think that the markets are going to tank by 10, 15, 20% because interest rates went up. I think they might be left hanging on to their cash and ultimately getting analysis paralysis, and they won't be actually able to go into the market and execute. Turning point, house prices across all states will fall in 2023 in NAB's views, with Sydney and Melbourne leading the charge lower with drops of 11.4% in both cities. With our view on rate hikes coming forward, we now expect the turning point in property prices to occur in the second half of 2022, Mr. Oster wrote. We see this as a relatively orderly decline, and it is important to remember this correction comes after a very sharp run up in prices over last year. We've seen it in any market, right? If you see markets pump 20, 30, 40%, especially like something that's as stable as real estate, you're going to have some periods of consolidation. But we need to go beyond just the cost of borrowing being the effect to this, because as we see in the share market and we're seeing in crypto, people are getting overly emotional by the uncertainty of potential rate hikes. Could they come? Yeah, definitely. And that's probably why some investors are taking a more risk-off approach. Now, if I was someone that sits back and says, well, would I rather invest in real estate or in cryptocurrency? If you're looking at the risk-off investors, they're going to real estate, the traditional markets, versus what's happening in cryptocurrency, and forget about NFTs. When it comes to ETFs, that's pretty much what people have as part of their long-term plan. They'll continue dollar cost averaging even if the market goes down by 10%. And I feel like a lot of smart investors, the smart money, they're sitting on the sideline and going, well, my property's grown over the last 2 years. I've got a bunch of equity. Now, if the prices do decline by 5, 10, maybe even 15%, which would actually be quite insane in Australia, is that they're going to be ready to swoop up those deals and they're going to buy up that market fairly quickly. So if you're someone that's sort of sitting there on the sidelines, reading something like this and saying,
Wow, prices might actually come down and I can afford something? Yes, please.
Buying a house in Sydney for $600,000?
Yeah, thank you very much.
I think you might be disappointed because this might be a very short move before people realize that a 0.25% or 0.5% increase in interest rates aren't really going to matter when the mass majority of people are going to go fix their rates for 3 and 5 years. Again, this is not financial advice and I only talk about my opinion. I could be completely wrong. The market could tank and you guys can come back to these videos and be like,
Ravi, you're so at investing.
But the truth is, that's just how it is at the moment. Where we look at the uncertainty and I look at the risk and reward. When you compare all of these things and then overlay that with the actual data that we're seeing on the ground floor, I think this could be an overestimation of these forecasts, just like we saw in 2020. And we also saw it in 2018 and 2019 when banks were coming out and saying we were going to get huge amounts of declines, but we actually didn't. And they overestimate how bad this move could actually be. And then on the flip side, you also have rents going up. then you've obviously got that upward pressure on prices to stabilize and consolidate. Now, if you're someone that actually bought a property and you're seeing something like this and freaking out, I think you just need to take a step back and realize that when you went in to apply for a loan, the banks did an assessment on your borrowing capacity based on an interest rate that was a lot higher than what you actually have. You have so many options out there. You have the option of going interest only, you have the option of fixing rates for a long time, and you potentially even have the option of taking out some equity and have it sit there in an offset account as an emergency fund in case things go bad. In my personal opinion, I think even if we do have a correction, it's going to be very short, but I know one thing is for sure, that in the next couple of months, I will be purchasing property up again. And I'm definitely not concerned by what these economists are saying because they were wrong for the last 5 years. Now, all of a sudden, everyone's paying attention again. As we start seeing high levels of immigration, we start seeing that supply shock come through. In some areas, we're still gonna see a strong market, very healthy. But that doesn't mean you go out there, take on huge amounts of debt at 99% LVR and hope for the best. You've gotta have a plan, you've gotta have a strategy, and you've gotta be able to know what your risk appetite really allows you to do. If you are interested in joining more conversations around logic versus the emotion of investing, then definitely join my Patreon community. You can find a link in the description below, and I'll catch you guys in the next one. Thanks, guys.